This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! I know that here on the show we talk a lot about the importance of bank partnerships when it comes to the success of any type of embedded finance or fintech endeavor. So let me tell you about a provider that is raising the bar in embedded finance. Built by Fifth Third Bank, Newline enables enterprises to launch and scale payment products using their API-first platform, enabling embedded solutions that scale responsibly. Learn more about Newline by visiting newline53.com. Hello, and welcome back to another episode of Not Fintech Investment Advice. My name is Alex Johnson. I am the creator of Fintech Takes, and I am joined, as always, by the man himself who has crossed the pond and is gracing us with his presence here in the U.S., in the capital of the United States, here in Washington, D.C. I've gotten to spend some time with him in person this week. Mr. Simon Taylor. Simon, how are you?
I'm really well, thank you. I have enjoyed being in the eye of everything happening this week. We literally saw the former FDIC chair sitting on stage as news broke that the current FDIC chair, Marty Grunberg, had resigned. And
Yes.
In a room full of regulators, in a room full of sponsor banks who are looking for some sort of change, it really felt like we were in the middle of the vibe shift. Shout out to the American Fintech Council, Phil Godfather, to Taylor McCarthy over there. They did a great job putting on a show, really bringing everybody together and talking policy. And, we're not out of the woods yet on fintech. There's going to be a long way to go. But it was fascinating, my friend. How have you found the week?
I have found it to be great. Would add your shout out on the American Fintech Council. They've been very gracious hosts and have put together a wonderful event. They were also one of the sponsors and I guess sort of co-hosts of the tech sprint that we did today, the mini tech sprint to workshop ideas with the Alliance for Innovative Regulation, AIR, Oric, which is a law firm here in town. There was a great team up that happened today where Simon and I both got to participate in the ideation process for how to help create more visibility between regulators and fintechs. And Simon, I enjoyed all the brainstorming. There was a lot of brain power in that room.
It was, and this is the best part of the job of being a creator, is actually getting into a room full of people and being able to listen to the on-the-ground experiences day to day, dealing with what is it like to be examined? What is it like? What documents do you actually have to produce? How does that differ? What are the challenges in that process for third-party risk management? So going from like the policy discussion to the practical application was fascinating. But, who knows? Maybe new fintech companies will be born out of that brain trust.
I hope so. And in fact, that is a good tease for our manifesting fintech ideas at the end, because I think I might bring some of those discussions back through the podcast for that section. But before we get there, as listeners know, this is an exercise for Simon and I every month to bandy about some fintech companies that we find interesting and just talk it out. So Simon, as a guest to our shores this week, I will give you the honor of going first. What's your first company?
I'm going to talk about Paydock. So Paydock is payments orchestration as a service. You've heard of companies like Primer, who will help me if I'm a merchant and I work with Stripe and Adyen and Fiserv, and I have 3 fraud vendors, and I might be using a platform like Shopify, and I might be using something else for my tokenization, my MailChimp, and whatever else. They help you build that into a seamless set of workflows. That's an awesome experience. And now what we're seeing is even companies like Stripe are going much deeper into billing and software and workflow and automation. If I'm a traditional acquiring bank, I'm going to struggle to compete with that. So what Paydock does is it works with an acquiring bank like a Wells Fargo or somebody like that. Not Wells, but you know what I mean. They're quite popular in the Middle East and Europe. They have clients there. And they say, we will give you the capabilities of a modern payments orchestration platform, of a modern PSP, to manage things like billing and recurring subscriptions, and to enable people to embed payments and all of these things that have made the modern PSPs capable. And we'll give you that to you, but we'll do it under a white label basis. So somebody comes to buy it from the bank, but their experience looks and feels like they're buying it from, one of the most modern companies in the world. So this is sort of like the bank direct model, but for acquiring, not issuing. And I thought that was fascinating. So this team has some traction in the markets they operate. There's a lot of payments expertise in here. But what I like about this is it really does potentially upgrade a bank's tech without that massive internal transformation. And then it gives them the ability to potentially sort of win those new customers with that new feature that they couldn't do before, but keep the price competitiveness. Because today banks are competing on price, but not on experience. Maybe now they can be competitive on price and on experience. And that's an interesting perspective. So what say you, Mr. Alex Johnson?
Well, I think that's a really, really interesting company. So I guess tying it into the news, and you would be in a better position to comment on this than I would, but like Barclays can't sell their merchant acquiring business, right? Like they're trying to basically give it away right now, and there's just no market for it. And I think what that illustrates kind of more broadly is banks' privileged position around merchant acquiring, since it's been disrupted by more modern providers like a Stripe or an Adyen or what have you. The idea that you can compete just on price has kind of gotten wiped away, right? And what I found to be really fascinating is you would think that the answer to banks' woes in this area would be, well, you need someone who can help you become a Stripe or an Adyen or someone like that. So like an all-in-one integrated solution that everything just works beautifully together, this sort of idea of a modern PSP. But I like this one because this is skating not to where the puck was, which is what I just described, but where the puck is going, which is uncoupled or modular systems by default, right? And so if you look to your point about like where Stripe and where Adyen and others are going, even they are decoupling payments processing from their other providers, because what they have found is while smaller merchants want an all-in-one solution that has everything bundled together and it all just works perfectly, larger enterprise customers, which are the prize, and by the way, those are the ones that banks have historically really had their teeth into and have been able to sort of hold on to largely because of pricing advantages. Those are the ones that the modern PSPs are moving into and going after. And those providers or those merchants, they want modularity. They want flexibility, right? And so while they want better usability, they want better products, they're not just buying on price maybe the way that they were. They aren't willing to sacrifice the flexibility. They want that ability to use different PSPs to cover different regions or to cover different things, or even just to sort of make individual PSPs compete over price. And so payment orchestration and modularity is incredibly important, especially to those enterprise merchants that operate across multiple countries. And so I do think this is a really well-timed and well-designed solution to sort of help banks. I feel like a lot of times the infrastructure or technology that banks get is designed to help them fight the last war rather than the next war. And this would seem to be infrastructure designed to help them fight the next war, which I really like.
Yeah, and I'm seeing a trend where there's definitely a recognition that we've either got to exit the acquiring business or we've got to transform it.
Yeah.
And there are in the US, a lot of smaller banks that do a bit of acquiring or are thinking about getting into acquiring. And it's like always one of those things that comes up. It's like, I need to get transactional revenues because I can't necessarily attract deposits. But making acquiring work, especially from a cold start, can be incredibly difficult. And so how do I get that and how do I move it forward? Well, I could go to one of the classic core providers. I could go do a relationship with one of the payments processors.
Mm-hmm.
There's still a lot of work for me to do on the tech build out side and the process side. Having industry payments people come along and go, well, here, we've done a lot of the work for you, and bring several processors to this if you want, or be the processor.
Mm-hmm.
We will just be your modular tech platform that can help you kind of deliver some value to market. Oh, and by the way, we don't have to do all of your products, all of your value-added services. We could just start somewhere with you because we are modular by default. And I think you've hit the nail on the head with, like, modular by default is the next war, is the next kind of thing in payments.
Yep.
But I also think it's becoming to the whole technology stack of incumbent banks generally.
Yep.
One pattern I'm seeing a lot is, every bank wants to get off their core. Every bank kind of hoped that getting into banking as a service would mean they'd have their side core figured out.
Mm-hmm.
Maybe that didn't work so well, but they're all looking for what's that side core. And something like this that gives you value today, but possibly a side core tomorrow, feels like a strategic, like, make money on the way to solving your long-term problem type of thing. That is the business case that a bank always needs. They can't do the, like, I'm going to invest for 10 years and hope it pays off, because most of the time it doesn't, and it just becomes a big write-down. Mm-hmm. I need something that can solve my gap in transactional revenue, because I can't just play the balance sheet game, especially if I'm one of the smaller banks. And this is doing really well in the Middle East and Eastern Europe. So those are tough acquiring markets where the margins have not always been great.
Yeah.
I suspect they could have some fun in the US.
Yeah, no, I'll be very curious to see how the transition to Western Europe, the US, other regions works for them, because, and I'm going to talk about a company that kind of fits into the same general category, but, like, the trick with this is always selling to incumbents, getting them on board with this vision. But I do think you paint a compelling picture of, if I can both be your answer for a year from now, but also 6 months from now, and also a month from now, like, if I can give you a roadmap where every step along the way we're making money and increasing your ability to be competitive, that really helps sort of lay down the tracks for a larger transformation. And I also think the other thing that it does is it is targeting an area, again, to our point, where it's like, the Barclays example is so instructive. This old school merchant acquiring business, there's not a lot more value to be extracted out of that, right? And so I think,
especially if that's not growing, right? Like, if that business is not growing and it's just treading water, or it's eroding, like, who's going to want to buy that? It just doesn't make sense as an asset.
And I think, like, from an internal politics perspective, like, what always kills sales to banks is the person who owns the P&L for the thing you're pitching to disrupt in some way, right? And so if that person has a lot of power, this is like why pay by bank is a tough sell to large credit card issuers, right? Is because Chase gets it, they understand the value of it, but they have a huge credit card business, and the person who runs credit card at Chase has an extraordinary amount of power inside the bank and can kill things that he doesn't like. This is not that, because if you operate a legacy merchant acquiring business as a bank, that person has no juice internally, right? And so, like, they're either going to be an ally for you giving them a path forward, or at worst, they're not going to be like someone who's exerting all of their political influence to kill it. And so I think that is a really powerful, I guess, hack for making traction inside of these large institutions where otherwise you just don't see any progress, even if the concept you're selling makes sense.
So one final thought on this one, which is, I think a lot of the problems we've seen some of the modern cores have is that they rely on this idea of the conversion.
Yep.
And like any conversion, it's just a horrific sounding thing.
Yeah.
And you've got, like, as you saw with, was it ViStar and
Nimbus?
Nimbus. Yeah. Like, if that goes wrong, that is huge issues, consent orders, everything. Like, you cannot get that wrong. It's just existential. The alternative is to have the side core running side by side in shadow mode with the real core, and have this integration layer over the top. That's good, but it doesn't necessarily pay its way with new products immediately, whereas this does. And potentially, because it's your intermediary layer, you could actually start to transform the underlying infrastructure as well. So this sort of modular thing between you and the customer that gives you revenue today, I think they're really onto something with that. So anyways, you had a similar thing. Talk to me about it.
It is somewhat similar. Yeah, it's a very different area, but it kind of speaks to this whole, how do you sell to large incumbents question. So mine is Bluespine. And Bluespine is a seed stage company incubated out of a VC firm. And they essentially help large companies that self-insure their employees for things like healthcare, right? So the idea is, if you are a sufficiently large company, and Simon, I'm going to describe something that might be a little bit more of a U.S. phenomenon in some respects. So please allow me to just get past the inherent craziness of some of the features of the U.S. health insurance market. But if you are a sufficiently large company, you might be interested, for a variety of reasons, in administering your own insurance for your employees, right? And there are a variety of benefits to doing that. But one of the drawbacks to doing that is that you essentially have to act as the insurance carrier in a lot of ways, right? So you have to take in claims, you have to evaluate those claims, you have to make sure, and this is a huge problem that we have in the US, that your employees are not being overbilled by their healthcare service providers. And you also have to make sure that any claims you reject are defensible and that you're not going to be violating the terms of service for the policy that you provide to your employees. So there's a reason why people don't typically like to be insurance carriers, even though at a sufficient scale, it can make sense to bring in-house and do yourself. So it's this very large, sort of strange market, and it has challenges sort of from an administration and kind of back office level. Well, in comes Bluespine, and essentially what they do is they provide a sort of AI, LLM-powered approach to ingesting all of the documentation and all of the information about each company's sort of bespoke insurance plans, because they're all different, right? Everyone has their own policy that they create. There's really not a lot of standardization. But you can feed all of those documents and all of those plans and policies into an AI system that can understand those. Then what it does is it tailors an automated approach to monitoring for claims. And so it can look for, based on the unique characteristics of that company's policy, things that are out of policy, places where someone might be getting overbilled, and it can essentially provide tailored claims management for companies doing self-insurance. So it's interesting to me on a number of different levels. One is that I kind of think, and you and I have talked about this before on the podcast, but like there's this idea of sort of massive but sort of invisible niches within the market. And I think this is a good example of one where it's like, I didn't know that this was a market until I read about this company. But, it's not hard to imagine that there's quite a few large companies like Mattel, the toy company, is one that they're working with already, that have, 10,000, 20,000, 30,000 employees and operate at a scale where they would want to or already are self-insuring. But the benefit is you can leverage this technology to do this. And the thing I was thinking about, Simon, and it kind of ties into this idea of selling to incumbents and how you do this, is you could sell more tailored AI-powered claims management to traditional insurance carriers as well, right? Like they would want it too. But the problem is, strategically, those large insurance carriers, the fact that this is a lot of work and is a pain in the ass and you have to throw a bunch of people at it, that's a competitive moat for insurance carriers that stops more companies from self-insuring, right? And so I've been thinking about, it's kind of like the Shopify Arm the Rebels concept a little bit, where it's like, what are areas that would actually make a lot of sense to insource or to do yourself? And the only real reason that you don't do it is because of the administrative headache or the sort of operational challenge of doing it at scale. And can we apply technology? And I think AI and LLMs in particular are intriguing in this sense. Can we apply technology to reduce the barriers there and essentially eliminate the competitive moat that insurance carriers, I'm sure there's a whole bunch of examples in banking that kind of fit in this model, that they use to sort of keep out their customers from doing it themselves. So I think this is a really interesting example of sort of enabling insourcing maybe in areas that we haven't seen before. What are your thoughts?
I love the Arm the Rebels enable insourcing theme of weird hidden niches.
Yeah.
I feel like there's a Fintech Takes essay to come on the very on like 5 or 6 examples.
Totally.
That could be the case. I think about another one, which is companies of a certain scale run something called an in-house bank, which is essentially, instead of just running a treasury operation, you actually run something that looks and feels a lot like a bank. It might not have a banking charter, it might have a banking charter, but essentially you are running a P&L every bit as sophisticated as some of the world's largest banks. The chief treasury officer of some of the largest companies in the world might as well be the treasurer for a bank. I mean, it's incredibly sophisticated, dealing with global supply chains of commodities companies, moving these things around the world, dealing with all of the assets, dealing with all of the suppliers, supplying financing to your suppliers, supplying financing to your buyers. You're a bank, essentially. And that's the kind of thing that when you reach a certain scale, makes complete sense. But it's the kind of thing that when you're a lot smaller, doesn't. But how much of that could you take to arm the rebels with? And how much does the CFO stack help you kind of get there? And we're already seeing. So I completely agree with you on the trend in hidden niches. The second thing that I see in this is insurance is weird and extremely broken.
Yeah.
Insurance is so extremely broken, and it's only just starting to hit a tipping point in the same way that I think capital markets is just hitting its tipping point. And generally, it's around the introduction of AI and LLMs become this sort of cost reduction, cost takeout thing in a way that cloud and APIs and mobile never seem to hit in either of those industries.
Yeah.
Those things really did transform consumer and commercial banking in quite a powerful way, and payments has been completely disrupted. But the nature of those two industries are so paper-based, so complex, so hidden, so niche, that I almost need this like low-cost army of experts to figure out what to do with all of this unstructured data.
Yeah.
And actually, that becomes a little bit more possible now. So fascinating company. Also, fun fact, when you first said Bluespine, I immediately got Sonic the Hedgehog in my head. And I like that about them too. Maybe there's a marketing crossover at some point. But what say you?
I was wondering where the name came from because, I mean, Simon, you do this too. Like, we look at so many fintech companies' names, and I see the same sort of variations on a theme constantly. So credit to Bluespine for a name that I don't see often and that does bring in very non-fintech connotations. So I'd love to know the story behind the name, but I completely agree with you. I mean, I think this idea that, like, we talk generically about generative AI will like rip a bunch of costs out of companies. Like, that's been a talking point around it for a long time. But I had never thought about it will rip costs out of companies, which will eliminate the competitive moat that certain companies have built to do things more cost effectively for a single function than a company could do by itself. Like, I hadn't thought about ripping costs out as a competitive moat for service providers. But when I saw this, I was just like, yeah, it feels like there has to be a ton of these legacy business models. And you can kind of, I guess, think in the same way that RPA on a much lower level probably destroyed certain areas where it's like, oh yeah, we could just automate that. You don't need to hire so-and-so to do that. Like, in the same way that RPA did that at a lower level, I think AI could do on a much more expansive basis across a lot more industries.
I think it's generally accepted now that the RPA 2.0 thing, it was an idea I was toying with 18 months ago, and it now seems to have become a bit of a meme. And it's interesting to see the market kind of come to that same conclusion, because I was just throwing it out there as it sort of looks like that, but it actually seems to be bearing that. So it was a complete hypothesis. But what I think is powerful about LLMs is they are very good at RPA works if you've got a structured set of inputs and outputs.
That's right.
But where the inputs and outputs may completely vary and there's just no consistency in formatting, there's only so much you could do before with traditional workflows and processes and RPAs, no matter how much OCR you tried to throw at it. This is something where I can just take a screenshot of some hand-scribbled notes and it pretty much understands it or gets a lot of the way there.
Yeah.
And then with additional context, it can do really powerful things. So that RPA 2.0 is definitely going to be the area. I saw a great statistic as well, which is I think it came out of a Money 2020 report, which is what AI companies are selling is you can do more. What companies are buying is this will dramatically reduce your costs. And that's so fascinating in that, like, everybody wants to sell the productivity revolution and everybody wants to buy the cost revolution. So how these two things will play out will be interesting to watch.
Yeah, I think the impact on end humans probably accounts a little bit for the difference between the way it's presented versus the way people sort of quietly buy it in the boardroom. But I couldn't agree more that that is seemingly the dynamic that is kind of taking hold. And good call on tying it to RPA. I remember that piece from a while ago. So seems to be playing out. Simon, give me your second company.
I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com.
My second company is called Astrada. So this is bring your own card as a service. They help platforms and marketplaces build an embedded finance experience like, travel or payroll or payouts, but users crucially get to keep their existing cards. So they benefit from all of their existing rewards programs, and marketplaces get to run like embedded finance without getting into issuing their users a card directly. So immediately I thought, well, this is the terminology that Navan has been playing with for a while, because Navan was sort of, they issued their own cards, but then they pivoted quite hard to BYOC, bring your own card. And that massively increased their partnership potential. I think they did a partnership with Citibank. They've done another one with Brex. So now you can embed travel just about anywhere, and Navan can be your platform for travel. And you can bring whatever card you want to that experience. Astrada says, all right, well, let's take that concept, but whatever else you want to do, we'll just make the card like experience of taking the transactions, making expenses that just work, kind of all of that things that you would get with a modern card platform, a modern expenses platform. But you can do that, and the user gets to keep whatever card they've already got, but you get these modern features that you would get out of a modern card issuing program. So it's like a best of all of those worlds. So I think this is fascinating, because the whole software as a service vertical SaaS space is just becoming fractals. You can embed everything inside of everything else. But the metaphor that really brought it home to me is like, canonically, Shopify offers the Shopify balance card. So you can manage you can buy things with Shopify. But instead of that, you'd get to keep your existing card, but it would have all of the same features with that tight coupling into the Shopify platform. So, you're giving up some of the economics on issuing the card, but potentially you're creating a lot of those experiences that you want to create as a SaaS platform. So it kind of moves away from fintech and the card being the revenue driver for the SaaS platform towards being kind of like the thing that keeps you sticky. But what say you, Alex Johnson?
So you're speaking to my secret heart, Simon Taylor, because card as a service and bring your own card is a concept I've been writing about a lot in the newsletter and looking at a lot. I had not heard of Astrada, so I appreciate you bringing them to my attention. I think you're exactly right. I think this fits into, again, this whole theme of like skate to where the puck is going. Navan tried the issue your own card thing, and they still do that. But I think what they found was their right to win and their core area of expertise is travel. And it makes a lot more sense to build the infrastructure, made a lot more sense for them to build the infrastructure to allow other cards to be used to still create that same magical Navan travel experience, right? And we have the sort of modern technology and APIs necessary to do this. What's been interesting to me is that we've also seen legacy card providers and the card networks take steps in this direction too, right? And so Visa and Mastercard have been updating the APIs built around their commercial card products to enable this same type of plug and play functionality. Citi, American Express, large issuers who are in this commercial card space, they've been doing the same thing. They've been building their own API stacks, essentially, to allow for their cards to act as the data that unlocks these experiences within these expense management systems. Because if you think about it from the issuer's perspective, they don't really care that much about the card. Like, they like the card business, they like the brand association of someone who works for this company pulling out a Citi card and plopping it down at the table at dinner. But fundamentally, most of their money is made with like treasury management and with all of these other services that they provide to these large companies. Even travel is kind of a drop in the bucket for these large issuers. However, these large issuers are very annoyed by these companies saying, yeah, we're going to use Citi for all this other stuff, but we really want Ramp, and we're going to use Ramp for expense management. Like, they see that as a threat to their product. And so the dominant sort of design pattern I think that's emerging in this space is, if you offer a card, you need to enable it so that it plays nicely with any other system. If you offer a system like Navan, you need to enable it so that it can play nicely with any card. And I'm taking away from looking at Astrada's website that they're basically saying, we've built the plumbing that allows card issuers to enable that level of flexibility, and you can plug in any card. We've enabled that for platform providers like a Navan, because other people besides Navan aren't going to maybe be as technically sophisticated or have the capacity to build this themselves. But our goal is to enable this sort of level of flexibility. And so then I think what it does is it allows everyone to sort of more directly compete in the area where they can specialize and where they can win. And, you know, Simon, to your earlier point, the sacrifice is, if we were making a little money on issuing the card and that interchange, that maybe goes away, right? And I think, maybe to turn a question around to you, sir, the thing I'm curious about is, Ramp seems to be the holdout here relative to everyone else, right? I was looking at Ramp, I was looking at Brex, I was looking at a few others. Well, Brex just did the partnership with Navan. They sort of have, I think, indicated that they're not going to try to own everything adjacent to expense management, spend management, travel, corporate banking. Like, they're not going to try to own everything. They're going to partner where it makes sense. Obviously, Navan did that. We're seeing the large issuers do that. Ramp is the one, and I'm not surprised by this because they're a product-led company, and they really take pride in the whole is greater than the sum of its parts sort of mentality, that sort of Apple philosophy for building products. Plus, their business model is still very essentially built around, we want to be the card that you use. Every time you use it, you save money, and it's sort of this iterative thing that adds value. I'll be curious to see, much in the same way as Stripe was sort of somewhat dragged into the area of more modularity and having to let go of certain parts and enable more of that flexibility. Do you think that comes for Ramp eventually, or do you think that different parts of the market will sort of take different approaches to enabling bring your own card versus you kind of have to use our card to unlock this experience?
So as long as Ramp's revenues and customer growth are up and to the right and a steep incline, then they don't have to do anything but keep shipping.
What's their incentive to change?
Yeah, so you just keep doing what's working for you. They seem to have a real wedge on, they're the best expenses card in the market, especially it's the one your users are going to love. And there are people that use Mercury and Ramp and Brex because they all do certain things slightly differently and slightly well. You know, you've got a good treasury account over here with with Mercury for your everyday banking. Brex gives you some of that more CFO tooling and some of that more capability around AP and AR and that sort of thing. And then Ramp is just the best damn expenses card in the business.
Yep.
And your users are going to love it. And it's going to give you all of those fine-grained permissions and tools in a way that others might struggle to kind of match. And its reconciliation is just beautiful. And they've gone out and launched travel to directly compete with Navan.
I know, yeah.
They're kind of at this interesting phase where they're either going to stick that landing or they're not. Like the core business is growing and doing extremely well. They've got what brought them to the dance, and it will grow and it will continue to grow. The path in front of that is expand into new geographies or expand into new products. Well, they're trying to expand into new products, and I think there's probably some customer pull taking them there, so they're right to follow it. But expanding into new geographies is kind of an interesting one for them. Expanding into new payments types, the ACH, the AP, the AR. Will they get traction on those products? If they do, and they can create a ramp-like experience, then maybe they can just keep running down that for quite some time. Maybe they've got a ton of runway in front of them. Or maybe they go through a phase a bit like Stripe's just gone through its difficult teenage phase, where, like the growth kind of slowed for a little while. There was only so far they could get. The biggest potential opportunity in front of them at the time, although I think this has changed for Stripe now, was winning in enterprise. And if you want to win in enterprise, your product offering has to start looking a lot more modular. And you also end up with your existing customers are now enterprises. So
they grow
Shopify
into it.
wants to be multi-PSP. It wants all of these. So it gets pulled into being modular to service some of its biggest clients doing some of its biggest revenue, and it has to keep them happy. So, this could happen to Ramp. Their products may stick the landing, they may not. They may serve enterprises, they may not. Or there's the whole other option of they just they kind of just keep that momentum going and they just win startups. Because what Stripe's really, really been amazing at is when there's a new category of company, Stripe serves them. They estimated that I think 86% of AI companies process on Stripe. And if you look at where all of the volume growth is at the moment, it's on AI companies selling new stuff. So stay
next to whatever the new tech sector is that just explodes, and if you capture 80% of it, you're in good shape, and you don't have to worry about those like fussy old incumbents that want more modularity.
And maybe
or at least
you
not
do,
right away.
but maybe that's not going to be the driver of your revenue growth. And if that's not the driver of your revenue growth, then you can stay a holdout for a lot longer. That's kind of the hypothesis.
Yeah, no, I think that's very reasonable. I mean, I also think the other thing that's kind of a distinguishing factor here is I think that corporate cards are just different, right? Like, again, they're not, they seem like the world to Ramp or to a Brex or to someone like that. But the reality is, corporate cards are not the most important sort of finance tool for large corporations. Like, it's kind of a sideshow relative to those other areas I was talking about before. And so it's possible that they can just live next to the other solutions that someone has, and they never really have to come into conflict. Whereas like PSPs and payment processing sits so core at the center of what merchants do that it's hard to hang on to that non-modular closed system approach that creates all these great products and these great experiences. So I could definitely see a world in which Ramp sort of carves off everything that's not touching those other core functions and continues to kind of slowly inch up market while adding more products. And if anyone can do it, it's certainly Ramp in terms of their product velocity and the quality of the products they ship. I mean, they are very much the Apple of the space, just in terms of like that premium feel and people buying something because it feels good to use, even if some of the other reasons aren't as compelling. So I think that's a very, very fair philosophy. Simon, can I give you my last company?
Hit me. Let's go.
All right. So you're going to like this one because it's I am Alex Johnson taking tentative steps into your world, Simon Taylor. So just like be gentle with me. I'm a newcomer, but my company I wanted to talk about is called Rise, who I think you may know.
Yes.
And they
Disclosure, I'm an investor.
I was going to say, this is cheating a little bit for Not Fintech Investment Advice, because this is actually an investment of Simon's, small investor in the company. But I saw them and I thought they were really interesting. So I'm going to do just a second on what I sort of perceive them to be, and then you can correct all the things I get wrong. But the basic pitch is payroll, sort of ADP style payroll, but for paying contractors, specifically contractors in other countries. So fits into this model of sort of the world is global by default, which we've talked about before. I think Angela Strange has done some good work sort of outlining a larger thesis on that idea. And the idea that, you're going to have contractors as a company that you work with that are in all these different countries around the world. And as with any cross-border payment opportunity being built in fintech these days, stablecoins is kind of the solution du jour that people are interested in looking at. And so my understanding is that Rise leverages stablecoins in order to allow companies to pay contractors in other countries. And part of the benefit of doing that is the payout can either be converted to the local currency in whatever country they're paying them. And I imagine they partner with sort of last mile providers to sort of do that currency conversion and get them the money in local fiat. Or, and it sounds like this is a smaller percentage of their business today, but maybe the bet is it grows over time, that those contractors in other countries, like Argentina, as an example, maybe don't love the idea of getting a payout in their local currency because they don't trust the stability of their local currency. So maybe they would prefer to just keep that money as a stable coin. And then I imagine there's a whole suite of things that you could potentially offer to those contractors that are sort of built on the premise of keep your money in as a stable coin, as a safe kind of stable store of value, because it's a US currency backed stable coin. I find that fascinating on a number of different levels. I'll stop there though, because you're much more knowledgeable, A, on this subject, and B, sounds like specifically on this company. What are your sort of key ideas here?
Yeah, so there's a couple of theses I've had for a while, and I was probably early on them. Number one was that stablecoins will become a cross-border rail, and that is now starting to play out. I think it's still early, but the Stripe acquisition of Bridge has kind of made everyone go, oh, maybe stablecoins, which is yes, stablecoins. How about that? What a crazy idea!
Sure.
And that sounded really arrogant, but you know what I mean. It's like
I do. One, and credit to you. Like you were talking about all this stuff when it wasn't very popular. You were also talking about it at the depths of crypto winter and lack of enthusiasm in the space. I mean, now we're surging again and everything's cool, and so the party has returned. But Simon, I recognize you. I see you in your sort of out there in the wilderness.
I feel seen now.
Okay,
I feel seen. I needed that. I really did. But what Rise has done is quite different. So if you are on remote.com or Deal or any of those platforms, you can open a Coinbase wallet and receive to that Coinbase wallet stablecoins. So that's kind of been there for a while, and I think there's like single-digit percentage of users across those platforms that will elect to take that today.
Sure.
But the problem is, in a lot of those last-mile markets, you don't have Coinbase. You have some other exchange, some other wallet. So it's kind of they've gone closed loop to limit their risk. What Rise has done is gone, right, well, we support multiple ways of receiving the money across multiple networks. Because the problem with stablecoins is, unlike the US dollar, you don't have to pick what flavor of dollar you want. You don't have to be like, I want a green one or a red one or a blue one. It's like, it's green. With stablecoins, you kind of have to pick your flavor. You have to pick your network. You have to pick your wallet. So Rise has solved all of that and gone, you're a payer doing payroll. You want to pay people. These people just want to get paid. Here are all the networks we support and all of the coins we support. Like, just pay them. And also, because we're a payroll platform, we can help you build a consistent payment mechanism. We can help you manage some of the compliance side of that. So the ADP side gets missed. It's not just payouts for payroll, which would be nice. We can actually help you build and manage the contractor, Or importantly, we can build an identity around this person, and this is the next big conversation with blockchain networks is going to be building that persistent identity around a wallet, so that if there is a contractor and Rise sees them in their network, they could be getting paid by 2 or 3 different people. They can build a marketplace. They can start to get into a contractor marketplace in a really interesting way. And they could even get into employee of record and paying those on a global basis. So I think the value of payouts, absolutely. The fact that it works and supports this complex bit of plumbing that people don't really want to deal with takes it from being a niche use case to being something where you could actually do global payroll. You can actually make global payroll work. And the amount of people that do now, since the pandemic, work all around the world, but want to be an employee of record. I'm an employee of record for Sardine, for instance, because it's a whole lot better for me for tax reasons, for benefits reasons, for a whole bunch of stuff. Like, I'm not going anywhere. I'm sticking with those guys. So, that can be really powerful. So Rise has been plugging away at this for a long time. And it's that multi-rail support of crypto networks. It's that identity, and it's ADP plus payroll payouts across all of those networks. And that, I think, is a powerful combination. So shout out to Hugo and the guys for plugging away and building this for quite some time. They've done a really good job building a business. And, sometimes timing is everything. And I think they've just caught the crest of a wave here. So congratulations to them.
Yeah, no, I mean, the crest of a wave thing, I think, is a good point. I mean, these things take time to develop into a model that makes sense to people. I'm glad you elaborated on the open loop, closed loop concept there, because I think that, that's always the challenge with these things is, Coinbase is great. And clearly they sort of saw this opportunity as well, but their incentive, much as we've been talking about with this sort of modularity versus closed system concept, like their whole model is built on closed loop. Like, we are one provider and we work where we work and we don't work where we don't work. But if you're trying to create ubiquity and you're trying to solve the problem for the company that has to pay people in a lot of different places, open loop is sort of necessary by default. And I do really like the idea of, essentially kind of what gets built on top of these things, right? Because as you were saying, cross-border payments is the sort of hair on fire problem that stablecoin solves for a variety of reasons. But once you have people using it, then like those next layer 2, layer 3, and I don't mean that in the blockchain context, I mean just sort of generically, the next couple levels down, I think that type of thinking around, can we build persistent identity? Can we start to think about, like, I think a little bit about, in fact, I was talking to someone earlier today about the sort of missed opportunity the last time we were sort of all excitedly experimenting with lots of crypto things, because there was sort of a parallel track around building more sort of persistent and stable financial products on this foundation. And we just didn't do it because the speculation wave kind of swamped all of that. And I'm cautiously optimistic that stablecoins as a foundation, by their definition and them being stable, sort of provides a more stable foundation for a lot of those other value-added services to get added onto in a way that was really hard the last time that crypto was booming, because we tried to build those same things. People saw the vision of like this alternative financial system and the things you could layer on top of it, but it kind of all got wiped away when the speculation wave just kind of washed all the sand back out to sea. So I do think that a more stable foundation creates a lot of long-term opportunities, as you were saying.
Yeah. And there's also just like bigger players at a more industrial scale in the market now. So BlackRock's Biddle fund, for instance, is a money market fund that lets you 24/7 transfer your stable coins, which do not offer yield, to a token that is stablecoin linked, and that's that is a money market fund. So, and you can move in and out of that stablecoin to money market fund 24/7 in real time. And so, and Ondo Finance has a similar capability that's at scale with multiple different money market funds. And what does that mean? Well, that means the infrastructure exists that if I'm at the last mile, I can take my stable coins, and I might not have a bank account that's offering me a yield on my deposit of 3%, 4%, but I can move my stable coins into a money market fund instantly in real time for almost zero cost.
Yeah.
That means that the US financial market becomes a global financial market, and it becomes available to people anywhere around the world. That's fascinating. It also means that if I'm a small business, I don't have to wait from Friday afternoon till Monday morning to try and move my funds into a money market fund. I can do that around the clock, 24/7. And so that 24/7 instant and global thing really is starting to, the penny has dropped on that. And I think the next 12 months are going to be, yes, people coming up the curve on stablecoins work, and I can use them for these like long tail, last mile global use cases, but also they're instantly exchangeable for other funds and other real world assets as a token. And that potentially allows me to create new financial products that are stable. But I'm with you on the it's hitting an all-time high again, and I'm kind of exhausted already for how silly this might get. And I really don't want that, because people are just starting to see the value that I always saw. It's like, for 10 years I've been in this ditch of like, no, I promise you it's valuable. And it's taken a decade, and we might be about to lose it all again. So I really hope it doesn't go that way.
I hope so too. I keep pushing on people to be like, those crystal clear rules and those modern rules you guys were like banging on about wanting. Now's the time to ask for them, right? Like everyone always asks for like clear rules when the rules are being strictly enforced. When the rules stop being strictly enforced, it's really telling, I think, over the next 4 years, who sort of quietly backs away from asking Congress for new rules and who presses forward and says, no, now is the time for clearer rules to build some of this cool stuff that you're talking about. And so I could not agree more. I hope it goes the way that I hope, because I've actually been very intrigued and not scared by a lot of the cool innovation that's come out over the last couple of years. So, Mr. Taylor, as we wrap up, if I could ask real quickly, manifesting a fintech idea, it's kind of what we've been doing this week as we've been in lots of meetings together. We've been parts of different brainstorming sessions. You don't have to spoil anything too intensely, but I was told in our brainstorming session today that the ideas belonged to everyone who participated. So maybe you could give us a little preview of some of the stuff that was discussed, and I'm happy to share an idea as well.
Yeah, so a couple of ideas came out that I thought were fascinating. One of them was this ability to have like a standardized dashboard for supervisors, both compliance teams looking at their fintech companies, and that sort of idea. Sardine does this to some extent, but this was looking at it in a broader remit. Sure. And another idea then was also backing that all the way up to the supervisors. So the supervisor could see the bank's view and could see all the way down to the programs. So I think this was OOF was the name of the team, and I thought that was fantastic. And then the other one was bridge builders. That was, and both of these teams won. So bridge builders, they were sort of talking about what are the opportunities for people who work in fintech to do a session on learning what it's like to do an examination. So examinations for non-examiners. And so that you could really see through the eyes of an examiner. But then flipping that on its head, what is the product management for non-product managers? So that as an examiner, you could start to see what are the KPIs that I'm thinking about when I'm building a new fintech product, and how am I thinking about how I treat customers fairly versus growth versus all of those sorts of things. And that in and of itself struck me as a phenomenal idea. So those were the two that won today, but I'd be interested in your views as to what stood out.
Yeah, well, I was just going to emphasize I was on Team OOF, and so I was very proud to be on one of the winning teams at the tech sprint today. But just to put a finer point on what you described, there was so much enthusiasm around finding ways to create more visibility. And that was sort of the prompt overall, right? Was like, let's try to create more visibility for regulators so they can understand fintech. And I thought the bridge builder idea of creating empathy by sort of walking a mile in the other person's shoes was a really good observation. And then, yeah, the idea that my team came up with, I mean, as you described, it's like, how do we surface more data to regulators about what's happening in fintech broadly? And there's like this data problem that we have. I remember it was like a year ago maybe, but the acting comptroller of the OCC, Michael Su, had a comment around like the OCC was looking into trying to understand how many banks that they supervise were doing banking as a service or partner banking. And it was just such a strange thing to hear a regulator say out loud, which is like, we actually don't know how many of our banks are doing this right now. And it's like, that's the kind of data that should be at your fingertips that you should be able to get answered in 5 seconds, right? And so the idea of almost having, I was sort of thinking of it as like the fintech equivalent to a call report that banks have to file, where they're like telling you, here's who we are, here's sort of our key performance metrics, here are all the banks we partner with and the structure of those relationships. And if all that data can flow up, it's not so much to allow individual fintech companies to get, in trouble with regulators, right? Those mechanisms already exist. There's already like, exams and consent orders that happen that go through
visibility.
Banks. Yeah, it's like visibility into the market and trying to understand where the next sort of nexus point like Synapse might be hiding that we could try to get ahead of from a regulatory and a rulemaking perspective. So people were very enthusiastic about it. I will continue to sort of write about and push that idea and others that came out of the tech sprint. But Simon, it was great to get to do some brainstorming with you. Thanks for sharing some companies. You and I are actually about to go grab dinner, so I'm very excited to gavel off the podcast and catch up on some things offline. We will do this again next month. Until then, Simon, thank you.
It's always a pleasure, sir. Catch you on the next one.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.